Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
All right, whenever you're ready.
Welcome back, everybody. I'm Jeff Barton. I'm your host for the Mortgage Voice here. We come to you each and every week. I'm remote in my house. Daryl's up in his studio, and I appreciate you listening. We are on a lot of different podcasts, certainly Google Music Play, Apple Podcasts, a number of different ones, as well as 4 radio stations in California and up in Nevada. We bring you this as informational currently. I'm going through some issues myself with some of the funding of loans that are sitting on the warehouse line, which is one of the products of the COVID virus issues that we want to deal with. It's the overall issue in the mortgage lending industry that is kind of not being addressed or even looked at by the powers that be currently. The reason being is that most of the funding being done on loans today are going to be, a month away from delayed payments, any forbearance. And there are a ton of forbearance loans in the marketplace, haven't really come to fruition yet. Reason being is because, we're still only 6 weeks into this. We're not 9 weeks, 9 months. We're not a severe loss of income for the servicers, and the servicers themselves have been forced to pay out to the investors through the mortgage-backed securities at Fannie and Freddie. Now, how does this affect you? How does this affect the things that you're trying to do with getting your loan funded? One of the things that is the problem is that when we look at treasuries, the reality of how we normally look at the rates that you're going to get charged. You're currently getting charged 3.5%, and you're thinking, oh, that's not too bad. It's almost near historic lows. Well, the problem with that is if you look at the bond market, which is, the yields are about 0.63 to 0.89, in the last 2 weeks. If you're looking at a traditional pricing model, those particular prices that we're looking at should yield you about a 2.5% mortgage interest rate. So you're paying a point to a point and a half more than you normally would. And those are for A-paper borrowers. Let's say you're a person who is, again, 750 FICO score. You have 20% down in order to get the purchase loan that you're looking for to buy that house. And you have a good, steady job with the prospects of keeping that job forever. You're the guy and the gal who can get a 3.5% loan, albeit I think it's a point higher than it should be. However, if you're the type of person that has really been hurt by this particular COVID pandemic in the mortgage industry, what has happened to people, and there's a reason for it. It's not as if we're out in the mortgage industry just to, stick it to you because we can, or the mortgage industry can. The reason is it's simple. Okay, so you're a person who has the desire to get a non-QM loan. Well, non-QM loans don't exist. For the places that they do exist, and we've talked about them before, Sprout Mortgage being one of them, you're going to pay a point to 2 points higher than the guy who is a paper guy who is already paying a point higher than what traditional loans should be priced at if you're looking at the way mortgage-backed securities are, their yields are looked at 0.63 to 0.89. Those are the spreads that we see right now. So that A-paper guy is getting charged a point more. And you, as the person who's looking for a non-QM loan, let's say you have business bank statement loans. Let's say you aren't, terrific at your FICO score and it's below 690. Let's say it's 680, 640. You're going to pay probably 4.5% to 5% on any loan that you're really going to get right now. Now, that is the way the mortgage market is. Unfortunately for now, and we don't know when that's going to end. We don't see federal help in the servicing sector so that those people can relax a little bit and start to price loans or have loans that they're going to be servicing protected. So the reason a lot of this is happening is because the risk Now, the company that I belong to and work for has a loan, currently an FHA loan that was funded in April 8th. Now, normally FHA loans are purchased right away by investors. This is on the banking side. This is on the mortgage banker mini correspondent line on the warehouse line. That loan's been sitting there since April 8th. Now, why has it been sitting there? Because there is no insurance on the FHA loan. Now, why is there no insurance? Normally, in a situation like this, either the lender, Malibu Funding, or the investor purchases the mortgage insurance that the borrower has paid for. However, HUD in Santa Ana, this is a California-based FHA loan, so the center in Santa Ana is closed. So you can't get insurance, yet FHA loans are still funded. So what does this mean? For small lenders like myself and Malibu Funding, it means that those loans are sitting on your warehouse line. What does that mean? It means that after a certain amount of time, you start to pay penalties. There is no workaround for insurance on FHA loans. So the problem being that you don't have insurance on the loan, you can't get it purchased off your line, and the investors can't go and buy it through Santa Ana, and these are problems. So how do people, now that's just one example of many. There are 3.5 million loans in forbearance. What is forbearance? Everybody knows what that is, right? If you have a mortgage right now and you're not paying, you're in forbearance. The federal government came out and said, look, do not pay your mortgage if you can't. And what was that really? It was an open invitation for people not to pay their obligations. If they could, they said, why? I don't have to. I'll wait. I don't know what's going to happen. Well, that's why your rates are high. Your rates are high because the people lending you the money are thinking, well, these people, what's going to happen to this forbearance? All of these particular issues in the forbearance world. And how are we going to protect ourselves for those loans, like a Malibu Funding loan that's sitting on the warehouse line? How are we going to protect ourselves? We have to charge more money. We have to protect ourselves by getting more money up front and getting more money in the servicing. And that's just how it's been. And that's why the mortgage interest rates are higher than they should be. And this is why people in the mortgage industry are afraid. Now, is the federal government afraid? Are the people who are regulating the industry looking at this particular aspect? Yes, they are. I think they're doing a good job, but they're more concerned with the individual borrowers rather than servicers or small lenders. Large lenders, the big 5 banks, have plenty of money in their portfolio, and they're also public institutions, most of them, so they get money from what their stock is doing, going back to the stock market, and also the ability to keep loans like that on their books. It's not easy for small lenders to do it because they don't have the liquidity. Now, how does all this affect you as the borrower? It affects you in rate, and it affects you in availability of funds. And as availability of funds, we all know the less funds available means that the price is, again, going to go up. Now, we experienced this a lot in 2008, 2009, and 2010, when credit froze and nobody could get a loan, and people were freaking out because the reality of me buying that house can't happen because there's no money to lend. Currently in the system, there is money to lend. However, how long that can last in a forbearance situation, and how long companies that are servicing loans, and how long can originators in the loan process remain doing business with uncertain futures? The uncertain futures are simply what does control the rate of your loan, what controls the aspect of open federal government services, whether it's the IRS or HUD or any other necessary. The IRS has to send you out the 4506T. The IRS has to send out the taxes. The HUD in Santa Ana has to insure loans. All of these things are affected, which is only going to drive the cost of loans to you up. It's just the way it is, and unfortunately, that's where we are. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening. Thanks very much for tuning in each and every week. We are on Google Music Play. We're on Apple Podcasts. We're on Spreaker. We're on a number of different podcasts, as well as the 4 radio stations, 3 of them in California, 2 in Southern California, 1 in Central California, and of course, up in Las Vegas, Nevada is our newest affiliate. Thank you very much. If you'd like to see this show as well as the rest of the shows that we've been doing, I guess for about 5-6 years, go to my YouTube channel, Jeff Barton, The Mortgage Voice. You see this as well as many other shows. It's been an interesting but also educational experience in the mortgage industry. We've been kind of left on our own, and I thought today would be a great time to reach out to our friends around the country just to see how they're handling it and what exactly is going on locally. Joining us today, once again from Atlanta, Georgia, is Lawana Bradford from the Bradford Group. Hey, Lawana, how are you? Thanks for joining us.
I'm doing well, Jeff. How are you? Thanks for having me again.
Yeah, I'm. As I said off air, I was a little bit doom and gloom on the radio. It's and I'll tell you why. Okay, we funded a FHA loan and we can't get it insured, so it's sitting on my warehouse line. You experiencing anything like this down there? You heard stories about it yet?
Oh my gosh, it's not good at all here. With the last month, I had 20 loans that were in the pipeline.
Yep.
I was only able to close 2 because the lenders that these loans were with, these were both on the commercial and investing side,
Yes.
they stopped their lending because of the market volatility. And so all of them right now are looking at their portfolios and reassessing the terms they want to do. And one lender actually just totally went the hard money route. And I thought, really, that does not help my clients.
Well, okay. So in as much as I've been contacted by many people who see this as an opportunity for hard money, what are the rates that they're asking versus, what we were comfortable with and really comfortable with in the non-QM world? And I'm not that familiar with the commercial rates, but give us an update on what the difference might be.
Well, so I'll just use the single family investment. The one loan that I was dealing with this particular lender, we had this borrower at a rate and term refi at 5.25.
Right.
They changed the terms now to 12.75.
Oh, so why would you do that loan ever?
Exactly. You wouldn't.
You 12%. So the lender is really saying the risk that they're taking. Now, why would they? Because they're worried about, obviously, the forbearance or the person losing their job. Is that what the scenario was, or are they just taking advantage and raising the prices because they could?
They're just taking advantage because they said their investors were very uncomfortable with the volatility of the market. On the commercial side, that makes a little bit more sense as to why they're slowing the lending down a little bit, because we know with the economic shutdown, most of these businesses are brick and mortar. So obviously, if you're not able to produce the revenue, that places your ability to repay that debt at risk. So I kind of get that a little bit. It's unfair, but I get it. But, just the 1 in 4 units, that doesn't make sense to me.
Yeah, I agree. And I think that, I was just remarking that I think the way the country is and how it's been split for, a generation or more in terms of trust in institutions, trust in government, trust in, anything. It's all pretty much everybody out for themselves, and have this kind of anecdotal story. It doesn't, it doesn't really bode well. What's the rest of Atlanta, and how is it faring in the lending world, do you think?
You're saying overall within lending?
Yeah, with lending in Atlanta, I mean, are you hearing anecdotal stories, horror stories, or are you just, the one that you just said was an anomaly?
Well, no, those are common stories. And when I speak to my peers, they're having the same issue.
I see.
Basically their business is slowed down to a crawl. Where we were first a little bit excited when the Fed lowered the rate, we thought, okay, great, we can really push on this refinance side.
Yeah,
But no,
right.
some you're able to get through, but it's pretty painful.
Yeah, I agree. I think having the mortgage industry fend for themselves, I think a lot of the issues with payment it's obviously a problem, right? I mean, people may lose their job, but at what point do we find there is a steadying of the ship and that people's risk tolerance is, I guess, for lack of a better word, it's less than it was. People would be satisfied. Are we still in that gestation, in that early phase where we're looking to see where it's all going to land? I think we probably are. What do you think?
Yeah. I think we're in the actually the infancy stages, because until all states fully open, we really won't be able to assess the level of damage that's been done.
Good point.
And even with the stimulus money that's coming out there, I mean, it's so delayed and the system is crashing. And, how much can people bear? How long can they keep trying to hold their businesses together? It's very sad.
Now, you own a business, obviously, and I never asked you, do you have office space as well?
We did. We actually had, when the market crashed in 2008, we took everything and went virtual.
Right.
Because of that high risk. So we sold our office building. We were down on Peachtree Street.
I see.
And now our staff all works virtually, which actually makes it easy because we had systems and things in place.
Right. Yeah, I have to
these waters.
Yeah, I have to say the same thing. I mean, for a lot of companies after 2008, and again, this is, how many years later are we now? 14 years later? 12 years? 12 years later. Okay,
yeah,
so
12 years.
And we know that our industry goes up and down like a yo-yo every 10 or 12 years anyway. So not that this was expected the way it happened, but in terms of the overall history of the market, this is the way it is. But we went virtual too, had to. Couldn't afford the offices anymore, especially when you weren't quite sure what was going to happen in the mortgage industry.
Exactly. And about 6 months ago, I remember you and I, we were talking, and we were predicting that something was going to happen with the market. There was going to be a decline. We didn't think it was just going to stop altogether.
Right. No.
But we were expecting, definitely a shift.
Now, Georgia has opened some of their shops, some of their stores, some of their businesses. How's that going?
Yeah. We're the laughing stock of the nation,
Hey, my sister lives there. If I laughed at her, she'd hit me.
Well, because what our governor has considered essential businesses are barbershops, hair salons, tattoo parlors, bowling alleys. I thought, really?
Well, it is Georgia. I mean, I hate to cast aspersions. No, I'm just kidding. Yeah, I agree. I don't know, but there is some call for that. Obviously, there are more political considerations, economic considerations than medical considerations, and the balance, I'm not sure what it is, but the governor down there, are people adhering to staying home, or are they actually venturing out?
They are starting to venture out, but it's interesting that many of these stores that have businesses that have been given permission to open, they're not. They said they just, first of all, they don't have the capacity to ramp up that quickly. Then they're looking at the added expense, the new processes that they have to adhere to. So it's like they feel it's just not time. They need a few more weeks to feel comfortable.
Luana, thanks. We're up against the clock. I really appreciate you coming on and giving us a snapshot of what's happening down there, and sharing some of your frustrations as we all have them, especially in business. We just want to get back to work. Thanks for coming on the show.
Thank you so much, Jeff. Be safe.
Hey, you too. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. And thank you very much for listening. You can hear this show through Apple Podcasts, Google Music Play, and wherever fine podcasts are heard. We are on Spreaker, the Big 8, and if you go to any of these different sites, leave a review as to what we're doing. If you like it, if you don't like it, the reason is that the more reviews we get, the more people can come and find us. We have a valuable daily and weekly different updates. I do a Mortgage Minute on Facebook, LinkedIn, Twitter, a number of different outlets. You can also see this show on our YouTube channel, Jeff Barton, the Mortgage Voice. We're also on 4 radio stations, and the newest one up in Las Vegas, Nevada, where our first guest is sitting at this moment, and he's been on the show before, from Intelligent Capital Solutions, Reed Blake. Reed, how are you?
I'm great, Jeff. Thank you very much. Good to be with you again.
Thank you. Now, I don't know if you know this, but we're on AM 1400 every Saturday morning in Las Vegas.
That is awesome. Congratulations.
Thank you very much. Oh, great. Yeah, it's a pretty good station. A lot of people know it. And this type of programming really is kind of right up their alley. But it does give you an outlet by which we can share the information that you have for us. And I know that you've done unsecured lending for a number of different years for a number of different clients. What is your business today? What's it like? And going forward, where do you think we're going to end up over the next 3 to 6 months?
Great question. To sort of answer the tail end of it, we're not 100% sure. We feel pretty good about things, though, overall.
Yeah.
As far as our business is going, it's gone very, very well. We've been pleasantly surprised. The volume of people coming to us, maybe because of the situation, has been higher, and we're doing well. The credit markets have changed a little bit, especially on the unsecured. As you know, Jeff, we do unsecured cash business lines of credit, unsecured cash loans. So two different tools in the toolbox. The unsecured cash business lines of credit, as we know, we call it forever money. You get a limit, you draw down, pay back. This is $10,000. Draw down, pay back. Draw down, pay back. Draw down, pay back. You just use it over and over and over and over and over again. A person can leverage 10,000 into 40, depending on how many times they use it. Right. Unsecured cash loan, a little different. That's a loan. It's not forever money. Start date, end date, amortization schedule. So anyway, as far as clients coming in and prospective clients coming in to acquire this type of operating capital, we're doing very, very well, pleasantly so. Our webinars tend to always have a lot of people on them. We got a lot of business flowing through. However, we are seeing some shifts in the unsecured, cash, what we call business lines of credit. Yep. The unsecured cards, the credit lines, unsecured cash in those. Historically, our clients typically in that first round, what we call round of funding, I know tranche is the new hip word, but anyway, that first round, historically, 80% of our qualified clients end up with between 50 and 100 grand. We're still seeing that a lot, but we're lowering expectations for folks. We're letting them know that we think that the approval numbers are going to be coming down, that we think they're going to be less than 50,000, generally speaking, as these organizations and companies try to protect themselves. Sure. We're seeing reduced time frames of interest-free. And the other thing we're seeing is we're seeing some institutions, some of your big tier 1 institutions, are reducing or closing new applications. Chase, for example, has stopped doing a lot, and unless you're an existing Chase client, we're not able to take people to Chase. As an example, Capital One today stopped new submissions. So again, it's temporary. Does temporary mean 2 weeks? Does it mean 2 months? We're not 100% sure. The rest of our funding sources are great, doing well. We're getting people through. It takes a little bit more time to get things done, just because all those organizations are typically working from home and et cetera. So
Right.
it's a little slower than when people are in their offices. On the unsecured cash loans, not a problem. Those are still flying through. We're doing great there, and that's been a really heavy area of focus. A lot of people are getting these lines and these loans right now in anticipation of a possible or maybe probable softening of the real estate market. And they want to take advantage of deals that are going to be popping up. Long answer to your question.
Okay. No, that was fine. And it just brought up a lot more interesting possibilities. So going to cash, however you get there, is one of the strategies by which you can pick up cheap properties. That's part of your market, right?
Oh, absolutely. Yeah. And we still have our $10 million lines for real estate investors. They're for real estate investors only, and we bring them in, we get them their 4 qualification criteria, we take them through, and then they'll get approved. Not necessarily for $10 million. They won't get approved for any less than $500,000. There are factors that come into that, but they may start out with, just keep it simple, $1 million, and then based upon experience and success, that's going to get those automatic limit increases are going to go up and go up and go up and go up. We've got one terrific relationship. We love these guys because once you're approved, you're approved. You bring deals in, they're going to get approved, period. And it's smooth. You don't have to sit there and requalify every time you do a submission. You don't have to have your credit pull every time you do a submission, things like that. So they run their line of credit really, really nicely. It's a big outfit, a recognizable name, and we've got a terrific relationship with the gentleman. So it's wonderful. Yeah,
Let me ask you a question.
The larger lines of credit specifically for real estate and loans are there. Oh, I'm sorry. Go ahead.
No, it's okay. The qualification today versus what it was 2 months ago, what's the difference? And do you see it getting tougher or easier?
Great question. Okay. For the higher unsecured cash business lines, you access with a check or a piece of plastic, that kind of thing. The qualification criteria is probably, on the high-end ones, harder. The big approvals for just unsecured cash that you get to use for any purpose, whatever you want, those are harder to qualify for. In other words, they've escalated the qualification criteria. Before, where you had to have, say, 200, just hypothetical, 200K of annual income, you've now got to have 500K. However, your regular sort of lines of credit, they are essentially the same. We're just seeing reductions in overall approvals, less exposure. So hypothetically speaking, someone who may have qualified for 80,000 in round one is now qualifying for 50 or 60,000. Someone who would have been at 50s, maybe at 30. But as you know, our model is we work with our clients for 2 years. It's a real mentoring program. So we're just like, start wherever we start. We're going to get you to where, the end goal of $500,000 to $1 million. On the real estate only lines, so it's dedicated to that. No real change there so far. ...
Right. Okay. So now let's look a little bit at where the Las Vegas local market is. Do you do a lot of business there, and what are you seeing in terms of reopening of the Strip?
Yes, we do business in Las Vegas. We've been seeing a lot of really good business out of Georgia and Texas. Texas, heavily. But in Las Vegas, we see, again, if it's the unsecured cash business lines of credit, client qualifies for that. They've got that money. They can deploy that capital however they choose. Their skin in the game money, their earnest money, their down payment money, their reserves, their rehab costs, closing costs, points, whatever the case may be, that your hard money folks want, that skin in the game money. That's great. The real estate only lines of credit, that's good to go. We've seen kind of a run up, but we're starting to see estimates of a softening. How much, no one's really sure, but we're starting to see that. I even think that's starting to be reflected on Zillow, but I don't. But the feedback we're getting is that the real estate prices are going to be softening, which from our perspective is get in, get the money now, get your loans, get your unsecured cash loans, because we're not having any problems with those right now, and qualify for. Let's get you qualified for what we can on the unsecured stuff. Because once you've got it, as you know, we teach people, we work very heavily on their profile. And because the profile is what determines, fundability. So we work on that profile so that those internal institutional scores, they'll start to get automatic limit increases frequently and for high amounts.
Reed, we're up against the clock. I really appreciate you coming on the show. Could you shout out your phone number for people to get a hold of you if they need you? Sure they do.
You bet. Let me give you a direct number to me.
Great.
Okay. And that number is 801-830-6240. Again, that number is 801-830-6240. Yes, I'm in Vegas. It's a Utah number. I've had it forever.
Reed, thank you very much. This has been Reed Blake from Intelligent Capital Solutions, talking about a lot of different solutions for anybody out there who's looking for a certain type of loan. Reed, thanks for coming on.
Thank you, Jeff. I appreciate the opportunity. I'm really great to be your first guest on your new station, and good luck with it. You'll do absolutely amazing. Great station, great people.
Thank you very much. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. If you want to listen to the show, you can see, hear, and really interact with what we do each and every week. We're on a bunch of different podcasts, the Big 8, certainly Apple Music Play, Google Music Play, Apple Podcasts, all kinds of other Spreaker, different Big 8 podcasters, as well as on a number of different radio stations, a couple in Southern California, one central up in Cape Tahoe, and a new affiliate out in Las Vegas, Nevada at 1400 K-Ship. We have a reach on the internet, of course. If you go to YouTube, my channel is Jeff Barton, the Mortgage Voice. You can see this as well as many other shows. We've taken to the internet again to try to update on a daily basis called the Mortgage Minute, and that's on our Facebook page as well as Instagram and LinkedIn. Given that, it doesn't mean that I'm the expert. I certainly ask a number of different questions and try to explain what is happening as far as the information that I know. But one of the things I wanted to bring our next guest onto the show was to ask her, because she's in this particular field, how does one who wants to take focus away from what people are doing, which is just daily staring at the internet about the next update, away from that, back into a mode of looking at my product, my service. Priscilla Vizentine joins us here today in that capacity in St. Louis. Priscilla, how are you today?
Believe it or not, I'm doing well, Jeff. It's a beautiful day here in St. Louis, so I think that lifts everybody's spirits.
Excellent. So my question goes to the heart of, I guess, in any disaster, and we've had enough of them in my lifetime, but let's just go through. We had the internet bubble, we had 9/11, we had the mortgage meltdown, and now we have this. We've had a lot of very big events which draw people in and keep their attention focused on that. How do you, as a marketer, as somebody who's in the business of trying to sway public opinion one way or another, how do you make or get those people away from that mindset into something that maybe benefits a client of yours?
Well, that's a really interesting question, and I have one of my biggest segments of clients is retail shopping centers. So as you can imagine, those are kind of in furlough right now. So one thing you want to be careful of with the pandemic that we're in right now, it's a global pandemic. It's not like 9/11, which of course was horrible, but it didn't affect the entire world in terms of the markets like this global pandemic is. One thing people need to be sure of when they're marketing a product or service, you don't want to sound tone deaf. So I don't want to be pitching to my media contacts, hey, let's do a fashion show on what to wear to the beach. I mean, first of all, I'd be laughed out of the business, but that's being totally tone deaf. So I think every business owner, business person, manufacturer, take a look at what you do, and can you migrate it to something that's relevant to what we're going through. I'll give you a good example.
Okay.
There's a client that is a window shade manufacturer. They actually manufacture like the honeycomb shades that go between two pieces of glass in your windows or your storm doors. Well, they were sitting in a meeting and they were like, what can we do? What can we do? Their IT guy says, why don't we make face masks? Hello?
Right.
You might want to call that a blinding glimpse of the obvious.
Right.
But he called people back to work. He's now supplying face masks. So that was a likely transition for him to make his product relevant. Now, we can't all make face masks, thermometers, etc. But let's say you're a cookware manufacturer.
Mm-hmm.
What are people doing right now? They are cooking like crazy. What I would recommend to them, go to their Instagram, go to their social platforms, start putting out some killer recipes that are, of course, made better by their cookware. But it's not banging them on the head going, hey, buy my product during the coronavirus. We're like, hey, we're cocooning at home. We're helping at home. Here's some great recipes. Oh, and by the way, if you don't have the equipment we're talking about, just click here.
No, that's a great idea. The idea of combining what is a bad situation with your product, with the sensitivity that the solution can be in this new thing that you're doing.
Exactly. And you're seeing now with a lot of automobile manufacturers, they're like, and they're trying to sell cars, right? Of course.
Right.
Who knows what that market's going to be. But they've all developed new financial payments that are attractive to people. If indeed you do need a new car, hey, you might have to pay us for 18 months or whatever the deals are right now.
80.
So people are trying to form and make their businesses malleable to reflect the situation.
Now, I am a football fan, watch the NFL draft, as I'm sure that many millions of people did the same thing, and people are dying for some form of entertainment. One of the things that is always that there seems to be a push to always attach whatever the disaster is, and everything is tagged in the thanking of numerous people involved, that there's an overkill factor. Do you want to avoid that in terms of an overt, like otherwise every commercial, every time you see something, and of course, we're all either on the internet or watching television or listening to the radio, it's always tagged with, we want to thank the blah, blah, blah. So by the time you've listened to a week of that or watched a week of it, you've seen 1,000 commercials for different things with the exact same message. Is there an overkill factor, and how do you avoid that?
I believe there is, Jeff, and there's also a deafness factor. Like you said, after you hear it 1,500 times during the week on TV, internet, whatever, it goes in one ear and out the other.
Right.
What I would recommend, and what I've said to my clients, actions speak louder than words. So whatever that means to your business, put an action to it. Don't advertise that. Don't just say it. Do something. And then post-event, you can, obviously it's great to do good deeds and not expect acknowledgement of it, but every business is in to make money. So perhaps send out a press release, send out an Instagram, send out a post. Hey, we delivered, maybe it's a Ford dealership, maybe it's your company. We're so thankful that we partnered with such and such restaurant. We put those folks back to work at the restaurant. Right. We also delivered 1,000 meals to the local hospital.
Love that. By the way, I read about that and I was like, okay, there's somebody doing something positive that makes me feel good about what they're doing and who they are. It's not necessarily getting hit over the head with, let's send our thoughts and prayers. If I hear another thoughts and prayers thing, I'm just gonna, shut off whatever it is I'm watching because it's meaningless.
And I'll be honest with you, Jeff. I sit on the board of a nonprofit, and every nonprofit, regardless of the time of year, but particularly now, is looking for donors, looking for funds, looking for donations. So on the board, my recommendation is, hey, let's send out our normal newsletter, but let's do personify it. Put a board corner and have the board members like, hey, here I am in my garden, or hey, here I am cooking, whatever. And then you're always going to have the donate button at the bottom, but you're not knocking people over the head with, we need money, we need money.
In your business, you're in advertising. Unfortunately, it's the first thing most businesses cut when they're going into any recession. It's just the way it is. How do you reinvigorate people's imagination that, no, it's probably the time to spend money in that area?
Because, especially with social media, You have to continually engage, surprise, and delight your followers.
Right.
So if you go dark, if you don't put any money towards it, people are going to think you went away. And once you lose followers, I don't have the stats in front of me, but it's pretty costly to get them back. So it's better return on investment. Even if you have to, lower what you're doing, keep doing something. Keep them engaged. And I love the term surprise and delight because we'll continue to look for you, to look at you.
Yeah, the market is segmented, and in a disaster-like situation, like we're dealing with now, because it's gone on for so long, are people now in the mode of not buying as much, getting used to buying online? How do you solve getting out of the house, pushing them back to the stores? We have about a minute left.
I'll tell you what, I think we have to count on the CDC for getting people back out of the house.
Okay.
My hope is that people will be so stir crazy and wanting to go out. We're seeing restaurants slowly reopen. They started with their takeout. I mean,
Right.
People are flocking to that. People want to get out. I think once smaller boutiques, maybe some outdoor retail, some lifestyle centers, people will want to come back out.
Excellent.
That's my
Priscilla,
hope. That's what I'm aiming for.
could you shout out your phone number if someone needs a good marketer, especially in nowadays? You seem to have your finger on the pulse of what's happening. If you could do that, mention your company name, that'd be awesome.
You bet. Thank you so much. It's called Byzantine and Ryan. We're public relations. We serve clients nationally, locally, regionally. My number is 314-422-5646. And we chat on the phone for free, so I'd love to counsel anybody, see what they've got going on.
Priscilla, thanks very much for coming on the show and giving us your perspective on what's happening and how we can maybe climb out of this thing. Thanks very much.
My pleasure. Anytime.
Thank you very much. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. You can see us, hear us all over the place. We've taken to doing 1-minute segments each and every day on Facebook. We have a Twitter account at Jeff6493. And certainly we're also on Instagram, a lot of different places, as well, of course, the podcasting, the radio stations, and of course you can see us on YouTube. If you go to YouTube, Jeff Barton, The Mortgage Voice is our channel. You can see us, hear us, and we really appreciate it. If you want to call me or email me at any time, you can do that as well. We love hearing from you because the way the mortgage market is today, it is... it's very challenging. It's challenging for the people who've been in the business. I've been in the business 25 years or more, and it's challenging for anybody who wants to buy a house. Certainly, if you're looking to take cash out of your property, all of these solutions to your individual problems really haven't been mapped out all that well, other than to say, hey, you don't have to pay your mortgage, or hey, we're going to try to do some things to help you along the way until we get back to the way it is going to be. So that's the question for today. When will we get back to that time that we were in February or early part of March this year? I'm optimistic about a lot of things. I'm not sure about this. I'm not sure whether that the 26 million people who have filed for unemployment, for instance, will have an opportunity to get back to work within the next 6 months, because that's really what the target is if we can get this done prior to the election. And of course, everybody looks to the election as the, I guess, the bellwether towards what we're doing today. Can we get to that with employment rising, with some of these health issues behind us? I'm not sure. It's anybody's good guess, but these are some of the things that we're dealing with in the mortgage marketplace, in the mortgage, trying to get you a mortgage. One of the other questions that I had was, and came up with a letter that Elizabeth Warren and this senator from Hawaii, Schatz, I forget his first name, they wrote a letter to Experian, and they addressed some of the issues that are taking place through no fault of the borrower, obviously, no fault of the buyer, no fault of the consumer. let's say you've got a loan right now and you lost your job and you're in forbearance. Okay. So we know right now that you're not going to be hurt for 90 days. Maybe you're 6 weeks into that forbearance period. It's possible the forbearance period may be extended. However, and that has its own set of issues, its own set of problems, right? But on the immediate, what happens to your credit score? What happens to, and as you well know, if you don't pay your mortgage, that's a huge hit on your credit score, and that's a huge hit on your credit information. But go down from the mortgage payment that you have to make. Maybe you have a car payment. That's not in forbearance. You got to make that car payment. Let's say you have credit card bills. Any number of automatic payments that you're making through your credit cards. I know that we do phone. I have kids on the phones. We can do some media, maybe some internet. There are all kinds of bills that you have automatically on your credit card or that you pay separately. All of this, if you can't pay because you've lost your job because of COVID-19, these are all going to be on your credit statements starting right away. So let's say that you are in a tough situation. You now are having all of these different items reported on your credit score. So the letter that Elizabeth Warren and this senator from Hawaii, Schatz, sent to Esperion today.
That's Brian Schatz.
What's that?
It's Brian Schatz.
Brian, oh, thank you. You know, I'm so used to Inoue, right? Or Inoue. He was the senator out there.
For a million years.
Right, he passed away. So this must be the person that took his place. And I really don't know who he is, but he and Warren sent a letter out. And the interesting thing about it is trying to figure out ad hoc and by the seat of your pants how to reinvent what the credit score does or doesn't do. Now, I'm of two different minds. As a consumer, I'm like, well, heck no, this shouldn't affect you. But the obvious question is, well, when does it start affecting you? When does the forbearance period, or when does the forgiveness period, or when does the actual reporting period begin anew and begin fresh? And when do you have to, take the responsibility of whatever your financial life is in your own hands, as opposed to, the forbearance? Now, as I said in an earlier segment, one of the issues with the government, generally the Fed or the Treasury, saying, look, this forbearance on your loan, or you don't have to pay your rent. The problem with that is you are giving people permission not to pay a bill. And is that the best thing? I don't know. I'm just saying what people are saying in terms of this being something that is really out of the universe, not out of the ordinary. This is so far beyond anything we've ever thought about, that the country would just voluntarily shut down and that the federal government would have to backstop the entire economy and everybody's bills for a certain period of time. Number two, the credit score itself is a flash of what it is that is your credit. It is not the determining factor for whether that credit score is used in a positive or negative fashion. It is just what it is. In the world we live in today, and I was thinking about this earlier for the show, I'm old enough to remember President Nixon, and I remember the anti-war demonstrations of that time period. And I remember that there was this very similar to what goes on with the president today, very, very similar. That at every turn, people were out to get him. And he was famous for hating the media and going after the media at the time. I believe it was the Washington Post, but very similar in terms of the distrust that the executive branch of the government had for the media. And so, like today, like then, I blame that whole process for some of what we're trying to deal with today. The trust in what we have in our leaders is so low that everybody seems to want to be in it for themselves. So when you have a credit score, which is supposed to be just recognition of where you are today based on simple criteria of reporting. Even as simple as that is, it's politicized. And what we have today is a country that cannot solve this massive problem without these particular things getting in the way of the solution. So what happens in regards to you and I trying to get a mortgage when it's not my fault that I can't pay my bills because I lost my job because the government told me I had to go home? How are we to solve this problem unless we solve it, together as a group? Well, the answer is simply in the mortgage business and in the mortgage end of things, we are on our own. Nobody is solving the problems that Malibu Funding has trying to insure a loan that they can't insure because HUD is no longer available because Santa Ana closed. Okay? The HUD office in Santa Ana, California closed, which is where everyone buys their FHA insurance, which means that problem is unsolvable until somebody tells me what I can do. That is across the board with every American who is trying to maintain their credit scores while they look for a job, get a job, try to work a job. That is one small aspect. The can has been kicked down the road. We're hoping for federal guidance. We're hoping for federal solutions. However, like a lot of things, we're probably going to be on our own. This is Jeff Barton. I'm your voice for the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.